Positive cash flow property. What is it? How do you define it? Why do people talk about it so much? What factors determine whether a property will be positive cash flow or not? And what does it mean to us as investors? Hi, thanks for joining me in this video. My name's Tim. I'm a property investment advisor and an active property investor. Now, when I first started investing, there was a lot of talk around and hype about positive cash flow property. In fact, some people were suggesting that if you didn't buy a property that had a positive cash flow position, then you're basically investing in the wrong way, which can be a little bit confusing, and also I think it's a blanket statement, and we have to be really careful about how we approach property investing, because there's so many ways to do it and everybody's different. So we really need to make sure that the property investment strategy that we adopt suits us as investors, rather than just following somebody because they say this is the right way to do it. So in this video, I'm going to run through calculations and show what it actually means for a property to be in a positive cash flow position. And then we also have a chat about, well, what does that mean to us? And obviously, again, as I just mentioned, it will mean different things to different people. So I just wanted to put this video together basically because there's a little bit of confusion around what it looks like and whether it is something that has to happen to be able to invest in property. So look, before we run through some calculations using the cash flow calculator, I just wanted to show you or provide a definition of what a positive cash flow property actually is. Okay, so what defines a positive cash flow property? Well, a positive cash flow property is a negatively geared property that has a positive net cash flow position. So ultimately, the costs exceed the gross income. So the costs associated with holding the property, interest on loans, management fees, insurances, etc., exceed the gross rental income we receive from that property or renting that property out. Now, as investors, we're able to claim some of those expenses against the tax that we pay. So there's tax deductions in this case are enough to cover the shortfall. So when we add back, if you like, the tax deductions, then that spins that property into being a positive net cash flow position. So ultimately the result is such that the net cash flow position is positive, and so the property is basically making money. It actually puts money in our pocket. So positive cash flow property is a negatively geared property with a positive net cash flow position. Alrighty, so when we perform cash flow calculations on any property, there's obviously factors that are involved in that calculation, and we'll see as we move through into these calculations that it includes such things as the purchase price, closing costs or purchase costs. It'll also include interest rate, the size of the loan, if we're going to fund the purchase entirely with raising debt, or whether there's actually a cash component as well. It'll include our marginal tax rate. It'll include the rental income that we receive, the annual expenses. So all these things go together in determining what that end result looks like. So let's move through now. We'll have a look at some of those calculations and we'll play around with those figures to see how that actually affects that end net cash flow position. Okay, so let's start with a purchase price of $400,000. The calculator will assume that the estimated closing costs of 5% of the purchase price. We will put in zero for the cash component, so we're not going to fund any of the purchase using cash. It's going to be entirely funded by a loan. So we will put in, to start with, an interest rate of 3%. Proposed weekly rent of $400, so roughly a 5% return. 14 days or 2 weeks vacancy per year, just as a buffer there. The estimated annual expenses, the calculator will put a figure in there, 30% of the annual rent. First year depreciation, put in $3,000, so assume it's an older property. You can use the BMT calculator, which basically you just enter the details of the property that you're looking at, and that will give you a figure. Marginal tax rate, 32.5%. So effectively, based on those figures, this property will cash flow at a positive $36.92 per week. So let's now change the purchase price up. Let's go with a purchase price of say 600,000. We will leave the interest rate at 3%, change the weekly rent to $600, so again a roughly 5% return, and we can see down the bottom there that the estimated weekly cash flow will be $46.01 in a positive position. So again, that property is actually making money, if you like, or is it in a position where the cash flow is positive, so it's actually putting money into our account. Now, we'll go right up to $1 million, purchase price of $1 million, $1,000 a week in rent, roughly 5% return again, and we will see then that the estimated weekly cash flow position is positive $70.43. So pretty much if we're looking at even a 5% return, which is pretty standard, on those various purchase prices, we will see that we're going to remain in a positive position. Let's now, I'll go back to the 400,000 purchase price, and I will take the rent back. Actually, I'll put in the rent of say $300 a week, and we'll see then that we'll be just under, or in a negative position, so just under $9 a week negative cash flow position. So even with a very, very low rent of $300 in a comparison to the purchase price of $400,000, I mean, if you can't afford $9 out of pocket a week, then you probably really need to ask yourself the question of whether you should be investing or not. So a positive cash flow position thereabouts, even with a very, very poor rent return on that purchase price. So I'm going to go back up to $400 a week, and I'll just show you if we really, when we're talking about positive cash flow property, the interest rate plays an enormous part on whether that property will be positive or negative. So when I was first started investing, interest rates are up around 9%, and it was very, very difficult to find properties that were in a positive cash flow position. So I'll show you, if we just even take this interest rate up to 5%, we can see now that property is now in a negative $72 a week position. So the interest rate plays an enormous part. If we took that interest rate right up to 9%, see now it's nearly, well, just under $300 a week out of pocket. That's on that 5% return. So the interest rate plays an enormous part. So go back to 3%. Now, if we were to even increase the first year depreciation and say it was a new property, we'll take that up to $10,000 as an example, then that's $80 positive a week on 3%. If we take that interest rate up to 5%, it's still going to be out of pocket just over $28 a week. So just showing you that for the purpose that the interest rate is really the major factor in how a property will cash flow, or its end net result. So we have to be careful that we don't think say again, I'll go back to interest rates being at a high, it is very, very difficult to find positive cash flow property. So anybody can look good, or anybody can tell you that they've got positive cash flow property when interest rates are at 3% or very low, as they are now. So it's, what are we, in June of 2020? So interest rates have never been slow. They're at a historical low. So right now there's positive cash flow properties everywhere. So if I did 5%, we say the interest rate 5%, out of pocket, just under $30 a week. So basically at the end of the day, if we start off at 3% and we're now at 5%, that's a 2% increase. And generally speaking, interest rates increase. When interest rates do go up, they're normally about 25 basis points or 0.25%. So you can see it would take, unless there was a big flurry of interest rate rises, it'll take some time for the interest rate to get from where it is now up to that 5%, or potentially could, based on what's happened in the past. So if that happened, and say it happened over a couple of years, and over that time our rent went from $400 a week to even $450 a week, then we can see that that's brought that up close to being neutral at least. So over time, if we purchase a property with low interest rates and we purchase quality property, then over time that rent will also increase. Obviously the purchase price or the loan doesn't go up, but the rent will. So therefore we're going to get a stronger return on our initial investment, and that way we can also manage increases in interest rates. Also too, obviously we've got that option of talking to a finance professional and determining whether it's worth fixing in a rate, particularly if it's low, just for peace of mind, if you like. So that gives you an example and shows you how the interest rate plays a really, really big part in determining the net cash flow position of any property. Okay, so I just wanted to cover a couple of things off here. Now, I mentioned way back at the beginning of the video that when I started investing, there was a lot of talk around buying positive cash flow property. So my view is that, and I've stated this a number of times in different videos, is that the cash flow position or cash flow is the lifeblood of any business, whether it be property investing or running an actual business, if you like, or even our family unit. So if you find a property, and I'll just use this as an example, let's say you found a property that was negative $100 a week. So effectively, you've got to take $100 out of your savings to carry that property. Now, again, just for the exercise, let's assume that you had $10,000 surplus a month. Buying a property that was going to cost you $100 a week, that you've done your research on, it's in an area that's going to produce capital growth, etc., would you be doing the wrong thing if you acquired a property that was going to cost you $100 a week if you had $10,000 a month surplus? Just as an example, my view is that no, you wouldn't be doing the wrong thing. So if, on the other hand, you are just lying in the sand, I really need to buy a property that's positive cash flow, and interest rates are high, then it's going to be very, very difficult to find that type of property. So you'll need to make sure that you sit on your hands and wait till interest rates come down to a point where it's going to spin that property, or you're going to be able to find positive cash flow properties more easily. So again, really it's about affordability. My view is that if you're acquiring property and it meets your affordability, whatever that looks like, then you're doing the right thing. Obviously, you've got to take into any things that could happen in the future, like, you know, if you're worried that you're going to lose your job, or somebody, when your partner was going, you're going to have children, your partner was going to, one of you was going to give up work for a little while, then yes, look, you've got to take that into consideration, absolutely. However, again, I stand by the statement that if you've done all those things and you've found a property, you've done your research, and the property cash flow position is such that you can afford it, then go ahead. So the other thing I just wanted to mention is that when positive cash flow property was all the go and interest rates were high, a lot of people were suggesting that you needed to acquire property that had a positive cash flow position, that you were going to sacrifice capital gains. Now, again, so, what do they say? A broken clock is always right, you know, once a day. The fact was, back then when interest rates were higher, that places that you needed to go to find a positive cash flow property, the markets you had to invest in were mining towns, could be niche type of properties like service apartments, etc. And as such, yes, they traditionally don't have as much capital growth as your standard residential property. Now, if that's the case, yeah, then you're right. However, where we are right now, as we've seen going through that exercise, you can find positive cash flow properties everywhere, because even a 5% standard return yield of a property is pretty much going to generate a positive cash flow position. So again, we really need to understand what it looks like to us, and therefore we can make informed decisions. We're not going to get led by anybody, one particular statement, or somebody we see on, you know, in the media talking about a particular type of strategy and thinking, well, they must be right and that's the way we've got to go. Once we educate ourselves and understand what the rules of the game are, and if we're talking about cash flow, again, that's the number one reason why people fail. Businesses, it puts a lot of stress on families if the cash flow position is poor. And property investment is no different. So understanding what that looks like, whether it be a positive cash flow property or a negative cash flow position property, then at the end of the day, if we do the right thing, work it back to what our affordability is, then we should be we're doing the right thing, and ultimately at the end of the day, we're going to find a property that's going to be something that we can hold on to, whether it's one property or a portfolio. And at the end of the day, once we get to the end of our journey, whatever that looks like, then our exit strategy will be such that we're going to realise that capital gain. So cash flow allows us to stay in the game, and then the capital gain is reward for staying in the game. So getting the cash flow position right at the beginning is critical. Having buffers is critical. Understanding where you are and what changes may occur in your life is critical. But really, they're all things that we should be doing anyway. You don't go on a holiday and spend $20,000 if you don't have any money. You don't go on a holiday and spend $20,000 if you are in a negative cash flow position. We shouldn't. So it's just a responsible position to take. It's a commercial approach, and that's exactly what we're doing should be doing when we invest in property. So again, I hope this video was helpful. Hopefully it's raised your level of understanding, if you didn't already have that, around what positive cash flow property looks like. And I really do truly hope that it allows you to think and move forward with property investment decisions if you're looking to invest. And a good starting point really is understanding where you sit, what you have left over at the end of the month, end of the week, whatever that looks like, and then matching the property to suit that. So look, thanks again for joining me in this video. If you feel free, please please feel free to subscribe to this, my channel, and also happy to hit the like button. That'd be great. And I really do, again, hope this has provided some clarity around what a positive cash flow property looks like. So look, thank you, and all the best with your journey.